Back on market eye into all the action on the Lal Street, where selling pressure gathered a fair amount of momentum during the fag end of trading. You had the Nifty then on closing settling just about above 5,900. The Sensex, as you can see, losing about 65 odd points as well. Investors have in fact turned cautious as foreign investors sold index futures, and the uncertainty of rate cuts that of course also continues to put everyone in a bind. But let's take it across to our experts this evening. Joining in, we've got Varun Goel, who's head of PMS at Karvi Wealth Management, and Roy Lobo, chief strategist and global head equities asset management at Kotak Mahindra Asset Management. Gentlemen, many thanks for taking time out for us and speaking with us this evening. All right, I'm going to start by asking you, off late things have been pretty volatile for us here in India, and honestly, depending on whom you're asking, you perhaps will get a different answer. So, the opinion in that sense is split on the street, right in the middle. Would you agree?
No, I think it's a function of a view on how the macroeconomic environment will shape up. And what we are seeing on the ground is that in number of variables, things are getting positive. The only concern that investors now have globally is the view on currency. And if currency does stabilize, I think the view will get more crystallized, and I would see a more favorable opinion towards India.
Varun, how would you characterize the current market environment? The year or the calendar year 2013 has been a volatile year for Indian equities. Even though the news flow has been pretty constructive, we've made very little headway.
Well, we are definitely positive on the markets at this point of time. I think as far as the global market environment is concerned, it remains fairly supportive of equity. If you look at asset allocations, there are very few assets that you can really invest in at this point of time, and equity clearly stands out as a winner in the short to medium term. I think as far as Indian equities are concerned, so far the year has been pretty flat, and we expect that second half should deliver us at least 15 to 20% return by December.
All right, the dollar index in the last couple of days has gone down, and still the Indian rupee is the worst performing currency in the entire region. You think it's too naive to blame the weakness in the rupee on the greenback?
See, it is obviously you're looking at a few days, but by and large I would say that if you look at the trends as far as the current account or the capital account is concerned, my sense is that the balance of payment this year will look much better than last year. And it's coming because of very, very strong portfolio flows. Just take the case of the three components of capital flows. One is clearly the FDI. We're already seeing the Unilever increasing stake in their subsidiary in India. We already saw Glaxo increasing stake. We're seeing the Diageo deal with United Spirits. We're seeing the Jet Etihad deal. So this clearly shows that the strong long-term money is clearly coming into India, and that is going to strengthen our capital account. Second is that on the portfolio flows into the country, last year we saw $24 billion into Indian equities from foreigners. This year we have begun with about $15 billion calendar year to date. Also on the fixed income market, with the opening up of limits and a reduction of withholding tax, we are seeing flows on debt also being pretty good. So on all the three fronts, the capital account is looking far stronger. On the current account, my sense is that the oil prices will remain relatively soft. And that will help the India story. The only, like I said, negative spot is the gold imports, and I would see the government, imposing more curbs to reduce the demand on imports of gold. If that really happens, we are actually looking at a very, very favorable, balance of payment, and that, in my view, will help support, the rupee and prevent it from, very steep depreciation from current levels.
Varun, you did mention earlier on in the show about how you folks continue to remain pretty bullish on Indian equities. So my question to you then is that you think as an investor, given the dips that we are seeing over the last couple of days, is this a good time to buy, or you think we'll go slightly lower and perhaps then one can enter into the market?
Well, it is almost impossible to time the market precisely, but we believe that there is not more than 5% downside from the current levels. In fact, there are several sectors. One really has to be really selective in terms of what one is buying at this point of time. Though, be it private sector banking names, pharma, FMCG, select pockets in IT, there are several opportunities in the market which are trading at low to reasonable valuations. And if one were to take a 12-month time horizon, I think there is enough value in the market. Plus, I just wanted to make a small point about the GDP data. I think if one looks at the services data point, it is clearly showing a rebound, and I think that's really the green shoots that one is really looking for. So if services do bounce back sharply as it is projected, and then we, I think, should see a 6% GDP growth for FY14, which would be a very positive number and which should support equities.
What about the liquidity picture? Currently 44% of the free float is held by foreign investors. If global risk-on trade reverses, do you think Indian equities also could fall apart because Indian markets are extremely dependent on global flows?
Well, definitely, global liquidity does remain, a significant factor as far as how Indian markets behave. Our own sense is that, the QE3, should continue, and we don't think there is going to be any time soon when, Ben Bernanke is going to withdraw the monetary stimulus that has been unfolding in US. In fact, there are a lot of data points which are floating around, but our own sense is that 6 to 6.5% is the unemployment should continue, and we don't think there is going to be any time soon when Ben Bernanke is going to withdraw the monetary stimulus that has been unfolding in US. In fact, there are a lot of data points which are floating around, but our own sense is that 6 to 6.5% is the unemployment rate, where they would probably want to see before they actually start withdrawing. So I think all concerns about a premature withdrawal of QE3 would get addressed in the next few meetings, and the liquidity should stay supportive of equity in the short to medium term.
All right, how would you approach currency sensitives? For example, the likes of IT, in particular Infosys, that was on a tear yesterday, and clearly markets cheering Narayan Murthy's comeback story. All right, I think we've lost that connection. Varun, let me ask you that question then about, IT stocks. And I heard you mention earlier on that you do see opportunity in certain IT counters. Is Infosys one of them?
Well, I think Mr. Murthy coming back definitely is a positive, but a lot of things would really have to change on the ground for us to have a more constructive view on the company. I think IT as a whole would play more as a defensive at this point of time. There, of course, companies, especially in the mid-cap space, which are far more attractively valued at this point of time as compared to the large-cap space. So we are selective buyers in that space, but I think within the large-cap space, there are very few stocks that one can really go for.
Elroy, let's be stock-specific here. What are your thoughts on Maruti? Yes, Maruti came out with blowout set of numbers, but given the fact that how yen has strengthened against the dollar and against the rupee in last 8-10 days, do you think best part of the rally in Maruti is now behind us? I'll be having some serious audio problem there. My apologies there. Varun, you want to jump in on autos, or do you want to talk about Maruti? Maruti appreciated in the month of May largely because of weakness in yen. Yen has strengthened in the last 8-10 days. Is it time to take some chips off the table when it comes to Maruti?
Well, I think as far as the broad auto space is concerned, one would take a more positive view on it. We expect significant monetary easing going further into the year. I think one key data point that we watched was the bounce back in tractor growth. I think that's a big positive. Tractor sales have really struggled in the last 12 months, and tractor sales reviving is definitely a big positive for all tractor players. Now, as far as Maruti is concerned, I think the yen thing is a little overplayed at this point of time. Of course, there's going to be a huge monetary expansion in Japan, and that would lead to a significant amount of weakness in yen. But I think, considering the kind of impact the market is already beginning to build in, there seems to be very little upside, from this point of time, especially considering the fact that the volume growth stays, extremely muted and probably has been running negative for the last few months.
All right, gentlemen, many thanks for taking time out for us, both Varun and Elroy. It was a pleasure chatting with you, gentlemen. We take a breather here on the show.